When you pay a health insurance premium, you think you're buying protection, coverage, a safety net in case something goes wrong. Here's what the company on the other end of that payment is actually buying: predictable cash flow, enormous investment reserves, negotiating power over entire hospital networks, and in many cases, direct ownership of the pharmacies, clinics, and doctors you'll eventually be sent to. You're buying protection. They're building an empire. Here's a number that should genuinely stop you. For one major category of coverage in the United States, insurers collected an average of nearly $14,823 per enrolled person in a single year, for a population that, on average, doesn't come close to using that much in actual care. The gap between what flows in and what flows back out as medical treatment is where this entire industry's real story lives. Today we're breaking down the real economics of owning a health insurance company, not through accusations, but through the actual mechanics, how premiums really turn into profit, why an 80% spending requirement doesn't mean what you'd assume it means, why insurers are quietly buying up doctors and pharmacies, and why the single most important skill in this entire industry isn't selling insurance. It's predicting the future better than everyone else in the room. Let's start with the basic equation underneath this entire industry, because it looks deceptively simple on paper. Profit equals premiums collected minus medical claims paid out minus operating expenses plus investment income earned along the way. Say an insurer collects $100 in premiums from a policyholder. Roughly $85 of that might go toward actual medical care. Another $10 to $12 might cover administration, technology, sales, salaries, call centers. What's left over becomes underwriting profit before taxes are even factored in. On top of that, remember the insurer is also earning investment income on money it's collected but hasn't paid out yet. We'll come back to exactly how valuable that detail is later. Here's the part that matters most for understanding why this industry can be so enormously profitable at scale. Insurers don't need enormous margins on any single customer. A small margin, multiplied across tens of millions of policyholders, can become an absolutely massive business. In 2024, average gross margin per enrollee in the United States ranged from around $608 for government Medicaid managed care plans, up to $1,655 for Medicare Advantage plans covering older Americans. But here's the crucial distinction almost every casual explainer video gets wrong. Gross margin is not the same thing as final profit. It excludes administrative costs, taxes, and a long list of other expenses we're about to walk through. This gives us the real investigative question sitting underneath this entire video. When an insurer reports $1,000 of gross margin per member, how much of that actually survives after the entire corporate machine behind it gets paid? Here's the full list of what actually sits between that impressive gross margin figure and the real profit an insurer walks away with, because it's a genuinely long one. Call centers and claims processing staff. Doctors, nurses, and medical reviewers employed directly by the insurer to evaluate claims, fraud detection systems and teams, broker commissions paid to whoever sold the policy, advertising and marketing spend, information technology infrastructure, legal and regulatory compliance staff, reinsurance premiums, which we'll cover in detail later, corporate headquarters overhead, and frequently debt repayments and integration costs tied to acquisitions the company has made along the way. Every single one of these categories chips away at that headline gross margin number before it ever becomes something a shareholder actually sees as profit. This is exactly why raw gross margin figures, the ones that tend to make dramatic headlines, can be genuinely misleading if you don't understand everything sitting behind them. A company can report an eye-popping gross margin per member and still be running a comparatively modest actual profit margin once the entire corporate machine has taken its share. Here's a regulation most people assume caps how much health insurers can profit, and it's worth understanding exactly why that assumption is only partly true. Under the Affordable Care Act, insurers are generally required to spend at least 80% of premiums on medical care and quality improvement in individual and small group insurance markets, and 85% in the large group market. If an insurer fails to meet this required medical loss ratio, it has to issue rebates directly back to policyholders. At first glance, this appears to hard-cap potential profit margins at somewhere around 15 to 20% of premiums collected. But here's the hidden detail that changes everything. This calculation depends entirely on how specific expenses get classified. Certain activities can be counted as quality improvement, which falls on the medical care side of the ledger, rather than as ordinary administrative overhead. This can include things like disease management programs, patient safety initiatives, care coordination services, certain digital health platforms, and clinical data analysis work. None of this is illegal, and it doesn't automatically mean anything improper is happening, but it does mean the real question isn't simply how much an insurer spends overall. It's which specific expenses get classified as medical care and which get classified as administration, because in a business processing billions of dollars, a few percentage points of reclassification can represent an enormous swing in reported profitability. Here's the reframe that changes how you should think about this entire industry. A health insurer's real product isn't medical coverage. It's predictability. The insurer genuinely doesn't know exactly how much care any individual customer will need in a given year. So it uses statistics at massive scale to estimate how many people in its pool will become seriously ill, how many will need surgery, how many will develop cancer, how many will require expensive specialty medications, how much hospital prices will rise that year, and how many claims will end up disputed or fraudulent. The insurer makes money specifically when its actual claims come in lower than its expected claims, after all expenses are accounted for. But here's a genuine paradox sitting at the heart of this business. If the insurer attracts mostly healthy customers, premiums will comfortably exceed claims. If it attracts too many sick customers, claims can overwhelm the premium pool entirely. Price too high, and healthy customers who don't need much care will simply leave for a competitor. Price too low, and the company might gain enormous market share while quietly losing money on every policy it writes. Getting this balance right, at scale, across millions of unpredictable human beings, is genuinely the central skill of running this business. This is exactly why scale is so extraordinarily valuable in health insurance. And it's not simply about lower administrative costs spread across more customers. A larger pool makes medical expenses dramatically more statistically predictable. A small insurer can be completely destroyed by a handful of exceptionally expensive claims. A massive insurer barely notices the same claims as a rounding error because the law of large numbers is quietly working in its favor. Let's put a real number behind exactly how much scale changes the risk picture, because the difference is genuinely dramatic. Imagine a small insurer covering 10,000 members, expecting $80 million in annual claims, but actual claims come in at $110 million. That's a $30 million shock, a devastating deviation that could realistically threaten the company's solvency and its ability to pay future claims at all. Now imagine a large insurer covering 10 million members, expecting $80 billion in claims, with actual claims coming in at $80, $3 billion. In raw dollar terms, that's a far larger absolute deviation. But as a percentage of the total pool, it's almost nothing, a rounding error the company barely notices on its financial statements. That's the hidden economic advantage scale provides in this industry, and it's genuinely different from the scale advantages you'd see in most other businesses. It's not just about lower per-unit costs, the way scale typically works in manufacturing or retail. It's about converting a genuinely unpredictable, potentially catastrophic risk into something closer to a statistically reliable, almost boring certainty. And boring, reliable certainty is exactly what makes a business easy to price correctly, easy to finance, and easy to keep consistently profitable year after year. Here's a source of profit that has almost nothing to do with medical care itself: the float. Insurance companies collect premium payments before they actually pay out claims, and health insurance has a particularly interesting version of this dynamic. A policyholder pays their premium in January. A hospital might not even submit a claim for services until months later. That claim then gets reviewed and negotiated. The insurer typically pays the provider weeks or months after the actual treatment occurred, and the final cost can sometimes be adjusted even further after that. During this entire window, the insurer is physically holding funds that economically belong to policyholders and healthcare providers, and it can invest a portion of that money in relatively liquid financial assets while it waits. This creates a genuinely less obvious source of profit. The insurer earns a real return on money that's simply sitting there, waiting to eventually become a medical payment. During periods of higher interest rates, this investment income can become a surprisingly significant contributor to overall profitability, sometimes rivaling the underwriting profit from the insurance business itself. But it's worth noting this isn't identical to the float dynamics in, say, long-duration life insurance, where money might sit invested for decades. Health claims get paid out relatively quickly by comparison, which means insurers can't safely park the entire float in long-term or high-risk assets the way a life insurer sometimes can. Still, even a short-duration float, invested carefully across an enormous premium pool, adds up to real money that has nothing directly to do with how well the company manages medical costs at all. Here's something most people never realize. Health insurance isn't really one single business. In the United States specifically, it's several genuinely distinct markets, layered under one industry label, each with dramatically different economics. Medicaid managed care, funded by government programs for low-income individuals, produced an average gross margin of around $608 per enrollee in 2024. Fully insured employer plans, the kind most working adults are familiar with, averaged around $846. Individual insurance, purchased directly by individuals often with government subsidies, averaged around $987. And Medicare Advantage, serving primarily older Americans through federally funded payments, produced the highest average gross margin per enrollee by a significant margin, $1,655. Remember, these are gross margins, not final profit figures, but the underlying reason Medicare Advantage produces such dramatically larger dollar margins isn't complicated once you see it clearly. It serves an older population with substantially higher medical spending needs, which means even a similar percentage margin, applied to a much larger premium base, produces a much larger absolute dollar figure. In 2024, Medicare Advantage plans received average risk-adjusted payments of nearly $14,823 per enrollee, the number I mentioned at the very start of this video. That single figure is exactly why Medicare Advantage has become one of the most fiercely contested, most heavily marketed segments of the entire American health insurance industry. Here's where this industry gets genuinely strange, in a way most policyholders never think about. In Medicare Advantage specifically, payments to the insurer are adjusted based on the reported health conditions of its members. A patient with more serious, well-documented medical conditions can generate a meaningfully higher payment to the insurer than a healthier patient enrolled in the exact same plan. This creates a powerful, direct economic incentive to identify every qualifying diagnosis a member might have, improve medical documentation practices, conduct thorough annual health assessments, employ specialized medical coding experts, and carefully search existing medical records for conditions that could affect a patient's official risk score. The legitimate version of this practice is simply better, more accurate documentation of illnesses patients genuinely have, which is a real and valuable improvement in care quality. The risk sitting on the other side of that same incentive is unsupported or exaggerated diagnosis coding, designed purely to increase the payment the insurer receives. Here's a real example worth understanding carefully. In a 2026 federal audit, investigators from the HHS Office of Inspector General found that all 97 sampled enrollees in a specific review had unsupported high-risk acute stroke diagnosis codes attached to their records. Based on that sample, the audit estimated approximately $462 million in potential net overpayments for the single year examined. It's important to frame this precisely and fairly. This audit concerned specific diagnosis codes in a specific sample, and it should not be interpreted as proof that every insurer, or even most insurers, engage in improper coding practices. But it does illustrate a genuinely important structural point about this entire market. In government-funded insurance, specifically, the medical record isn't purely a clinical document anymore. It can also directly influence how much the insurer gets paid, which means the incentive to document more conditions more thoroughly is baked directly into the business model itself. Here's the strategic shift reshaping the entire industry right now. Modern health insurance companies are increasingly transforming into full healthcare conglomerates, rather than staying purely in the business of selling coverage. They may directly own or tightly control their core insurance plans. Pharmacy benefit managers who negotiate and manage prescription drug spending, mail-order pharmacies, physician groups, urgent care clinics, data and analytics companies, home health businesses, surgical centers, and care management platforms. This entire pattern is known in the industry as vertical integration, and the economic logic behind it is genuinely straightforward once you see it laid out. If one company controls multiple different stages of a single healthcare transaction, it can potentially capture revenue at every single one of those stages, rather than just one. Walk through what this actually looks like in practice. The insurer receives the premium payment. Its own pharmacy benefit manager negotiates and manages drug spending on the plan's behalf. Its own pharmacy fills the prescription. Its own clinics provide the actual medical care. Its own data company manages and analyzes the patient's health information throughout. And the company reports one combined financial result to its shareholders at the end of it. This structure can genuinely create real efficiency and better care coordination. But it also makes outside financial analysis dramatically harder, because it becomes genuinely difficult to identify which specific revenues and expenses actually belong to which part of the business. Here's a striking statistic worth understanding. Analysis has found that 86% of Medicare Advantage beneficiaries were enrolled in plans whose parent companies also own related healthcare businesses, based on data spanning 2016 through 2019. And one 2023 analysis found evidence that vertically integrated plans had roughly 46% higher gross spending per Medicare Advantage beneficiary compared to non-integrated plans. This raises a genuinely important question worth sitting with. If the same company owns the insurance payer, the pharmacy benefit manager, and the physical clinic a patient visits, is it still functioning as a neutral middleman between patients and healthcare? Or has it effectively become the entire healthcare supply chain, collecting a margin at every single link along the way? Here's a barrier to entry that separates health insurance from almost any other business you could theoretically start. A person cannot simply create a health insurer with a website, some software, and a marketing budget. Owning one requires navigating state insurance licenses, hiring actuarial teams to price risk accurately, maintaining statutory financial reserves, meeting substantial capital requirements, negotiating provider network agreements with hospitals and doctors, complying with detailed claims processing regulations, following consumer protection rules, arranging reinsurance coverage, and submitting to regular financial examinations and ongoing solvency monitoring by regulators. The core requirement underneath all of this: the insurer must hold enough capital in reserve to survive a year where claims come in significantly higher than expected. In the United States, the National Association of Insurance Commissioners uses what's called risk-based capital requirements, which weigh an insurer's size against the specific risks embedded in its assets and operations. A capital ratio of 300% or higher generally avoids any regulatory intervention. Ratios that fall below 200% can trigger corrective action from regulators. And a ratio below 70% requires mandatory regulatory takeover of the company under this framework. This gives us a genuinely important reframing of what running this business actually requires. The first job of anyone owning a health insurer isn't maximizing profit in a good year. It's surviving the year when the actuarial model turns out to be wrong. Here's a layer of this business most policyholders never think about at all: reinsurance, essentially insurance purchased by the insurance company itself. A health insurer might arrange that it personally pays the first $500,000 of any individual claim, while a reinsurer agrees to cover any amount above that threshold. The insurer pays an ongoing premium to the reinsurer specifically for this protection. This arrangement exists to prevent one extraordinarily expensive patient, a sudden disease outbreak, or an unexpected surge in treatment costs from single-handedly damaging the entire company's financial stability. But reinsurance isn't free protection. It directly reduces overall profit, because the insurer has to pay for that coverage regardless of whether it ever actually needs it in a given year. This creates a genuine, ongoing strategic tension that every insurer has to navigate. Purchasing more reinsurance coverage means greater financial stability, but lower potential profit in a good year. Purchasing less reinsurance coverage means greater potential profit if things go well, but genuinely greater insolvency risk if they don't. Every insurance company owner is constantly balancing exactly where along that spectrum they want their business to sit, and that single decision says as much about their risk appetite as almost any other choice they make running the company. Here's a genuinely important warning for anyone trying to evaluate whether a health insurance company is actually healthy as a business. A company can report a strong profit margin in a given quarter while simultaneously becoming financially weaker underneath the surface. A serious evaluation of an insurer needs to look well beyond the headline profit figure at metrics like the medical loss ratio, the administrative expense ratio, the combined ratio, risk-adjusted capital levels, reserve development trends over time, days of claims payable sitting on the books, membership growth or decline, medical cost trend lines, how concentrated the business is in government-funded programs, specifically investment income, outstanding debt levels, goodwill sitting on the balance sheet from prior acquisitions, and actual cash flows generated from core operations. Here's why this matters so much. A low medical loss ratio isn't automatically a good sign. It might genuinely reflect strong underwriting and accurate pricing, but it could just as easily reflect delayed claims processing, an unusually low period of healthcare utilization that won't last, or simply a difference in how certain expenses are being classified. Equally, a high loss ratio isn't automatically a bad sign either. It could reflect a deliberately competitive pricing strategy designed to win market share, or a genuinely accurately priced population with legitimately expensive medical needs. This is exactly why gross margins and medical loss ratios alone can't determine an insurer's real final profitability, because both of those figures exclude administrative expenses and taxes, the same corporate machine we walked through earlier in this video. Now let's shift focus specifically, because the economics of this industry look meaningfully different depending on which country you're evaluating. And if part of this audience is based in India, the American figures we've covered so far shouldn't simply be assumed to apply the same way. In India, this business is typically discussed using a different set of core metrics: the incurred claim ratio, the claim settlement ratio, the expense ratio, the combined ratio, the solvency ratio, premium growth rate, reinsurance dependence, third-party administrator costs, and hospital network negotiations strength. According to India's insurance regulator's annual report for 2024 to 2025, net incurred claims in health insurance rose to approximately 84,850 crore rupees, while the health business incurred claims ratio actually decreased from 88.15% in 2023-24 down to 86.98% in 2024-25. India's regulatory solvency control level generally requires insurers to maintain available solvency resources at least 150% of the required margin, a somewhat different structural approach than the tiered risk-based capital system used in the United States, but built around the same underlying goal: making sure the insurer can survive a genuinely bad year. Here's a crucial distinction worth understanding clearly if you're evaluating an Indian insurer specifically, claim settlement ratio, and incurred claim ratio are genuinely not the same thing, even though they sound similar. Claim settlement ratio measures how many claims were actually paid, by number or by amount. Incurred claim ratio compares total claims incurred against total premiums collected. Neither metric alone tells you whether a given insurer is genuinely profitable, financially solvent, or actually easy to deal with as a policyholder filing a claim. It's also worth understanding why standalone health insurers in India can sometimes show lower claim ratios than public sector general insurers, how negotiated hospital discounts directly affect real claims costs, why cashless treatment networks create meaningful bargaining leverage for insurers, how third-party claims administrators influence the entire claims process, and why a lower claim ratio, while good for an insurer's profitability, isn't necessarily good news at all for the policyholders actually depending on that coverage. Let's bring everything in this video together into the one question that actually matters most. Is a modern health insurance company still functioning as a neutral middleman, simply pooling risk and paying claims, or has it become something closer to an entire self-contained empire spanning insurance, pharmacies, clinics, and data, collecting a margin at every single stage along the way? The honest answer is that it genuinely depends on the specific company, the specific market, and the specific regulatory environment it operates within. What's true across almost every version of this business, in every country we've discussed, is the underlying economic logic sitting beneath all of it. This was never really a business about denying or approving individual claims one at a time. It's a business about controlling uncertainty at massive scale across millions of unpredictable human lives, using statistics, reserves, reinsurance, and increasingly direct ownership of the healthcare system itself. The company that predicts medical risk accurately, manages healthcare costs effectively, invests its reserves carefully, and expands thoughtfully across the healthcare chain can earn genuinely enormous, durable returns for decades. But one significantly bad actuarial estimate, one major regulatory change, or one unexpected surge in claims can turn that same business into a genuine financial crisis, almost overnight, which is exactly why, underneath every profit report and every marketing campaign in this entire industry, the real skill this business has always demanded is the ability to predict the future slightly better than everyone else in the room. And to survive gracefully on the days it gets that prediction wrong. If this changed how you think about the next health insurance bill or premium notice that lands in your inbox, subscribe, because we're just getting started pulling apart the businesses hiding behind the headlines. See you in the next one.